the mainstream media believes that central banks are central. But we recently saw something in the Wall Street Journal where an opinion column suggested the opposite, that maybe not that they're doing it wrong, but that maybe they don't know what they're doing. And I'm referring to an article on, let's see, what day was it? January 3rd in the Wall Street Journal. Is an opinion column by Andy Kessler, and it quoted 4 times Jeff Snider, the head of global research for Alhambra Partners. Jeff, welcome to the show. How did it happen? How did this go? Tell us what happened. How did Andy reach out to you, Mr. Kessler?
Well, I talk to people in the media all the time, and I know I'm very harsh on them, but there's quite a few of them who are open-minded and honest and really are interested in getting at the truth, and they can be evidence-based. Yes, they have their biases. A lot of them come through economic schools and mainstream process and things like that. But there are occasionally some reporters and some people in the mainstream media, as I said, who really are interested in the facts and really are interested, as the overused term, holding truth to power. They really are trying to say, look, this isn't working out the way that we keep saying it is. And you know what? Damn it, I'm kind of embarrassed that I'm going along with it. I think we need to start looking at things more objectively and taking them into detail, and not just taking the word of these officials that we have just taken the word of and taken for granted for so very long. And that's really, the mainstream media, and you can understand why this is. I mean, in complicated and complex technical topics, things like we're going to talk about the repo market, nobody really knows about it. So if you're investigating something like that, where are you going to get your information? Where are you going to get your trusted information? Well, we've been told for generations that you go to a central banker because they know money. They know how the financial system works. And so if a central bank official says, this is what happens, who are you to challenge it? Well, the only reason you would is if what the central banker says in reality ends up being are 2 very different things. Then that's when you should start asking hard questions. And there are people out there who are doing so. And from my, minimal vantage point, I can tell you there are more out there these days asking the right questions than there have ever been.
I often get interviewed by the press as well, but they always ask me to be an unnamed source and anonymous. So a lot of those quotes belong to me, but it's never attributed to me. But you were attributed here 4 times, as I said. And the column, by the way, that we're referring to, everyone, is called How the Fed Stifles Lending. And again, January 3rd, Wall Street Journal, Andy Kessler. That's the headline. The drop head in newspaper terms is quantitative easing hoovers up bonds, leaving less collateral for eager borrowers. Here's how it starts out. Quote, Dear Jerome Powell, end quantitative easing now. Wow. The Japanese tried QE in 2001, buying government debt, mortgage securities, and even stocks. It didn't work. The Federal Reserve has tried it 4 times since Lehman Brothers went belly up in 2008. QE doesn't work, and instead of keeping markets stable, it creates instability. That's all, Mr. Kessler. How hard was it to convince Andy of your thesis, or was he amenable?
No, he's been on the, kind of a skeptical crowd for many years. And I think what happened, and I don't want to speak for him, but I think what it was is he had these thoughts and he had these impulses and these ideas, and he didn't have, as we keep saying around here, he didn't have the framework or the reference points to understand what he was seeing. He could tell there was something wrong, and he had mentioned the collateral system going back to some of his columns, way back when. So, I mean, he had this idea that, look, this QE stuff, it doesn't seem to be what everybody says it is. And oh, by the way, as he wrote in his introduction, this stuff doesn't work. It doesn't do what central bankers say it does. And so now he's asking the question, why? What is going on here? And that's really what we want, is we want the media to say, okay, report the facts and report what's going on, not just repeat or become a stenographer for what any central banker says they want you to know. And that's what drove him to contact me to say, look, can you give me some more information, more background, some more detail about what really goes on in these positions? And that's really where we kind of worked together a little bit last year and then revisited the topic this year. Of course, because in between, between, the repo market disruptions in September of 2019 and March 2020, what was the Federal Reserve doing? As we've talked about many times here, they were buying T-bills, and they were buying exclusively T-bills, which was the exact worst thing they could possibly have done. And so it was sort of for people who were just arriving at this realization and thinking, okay, there's this collateral thing, what does QE actually do? What happened last year and up until March was sort of a proof of concept. We're testing the theory. Is the Federal Reserve making it worse? As you could tell, from what happened during March of 2020, yeah, they did. They screwed up the repo market system on the collateral side.
Let's continue with the article. Kessler continues here. The Fed supervises and regulates U.S. banks, but traditional banking, think Mr. Potter from It's a Wonderful Life, represents only 15% of all lending, maybe less. The rest is the mysterious sounding shadow banking system. Now, I do not believe that 15% is correct, and let me cite a Bank of England report. Quote, this is a Bank of England report from 2014. Of the two types of broad money, bank deposits make up the vast majority, 97% of the amount of currently in circulation as of December 2013. And in the modern economy, those bank deposits are mostly created by commercial banks themselves. Jeff, am I maybe mislabeling or conflating lending and money creation? Or is the 15% actually much, much less when it comes to traditional banking?
No, I think what Kessler is citing is the idea that the traditional depository model, the mom and pop bank on the corner, the savings and loan or the trust business, those are a product of a bygone era. And that bygone era isn't, 2005. The bygone era is 1940. I mean, let's face it. As we talk about, especially in Eurodollar University, the monetary transformation into Eurodollars and wholesale money was also a parallel banking transformation into what, today some people call shadow banking. It's the same kind of the wholesale bank model, whatever you want to call it. I just wrote another article, they called it in the 70s, liabilities management. I mean, there was any number of names and terms for it. What it really is that the banking system, the monetary system, changed out of the mom and pop local corner, the bank where you bring in cash, depositors bring in cash, there's a vault, there's money in it, there's fractional reserve lending that takes place, all that kind of stuff. That's all anachronistic. It's the real modern system is this wholesale shadow money system that spans the entire globe. And there, if you go back to the economics textbook and what we're all taught from day one, there's hardly anything about these things in it. And so not only are we unprepared for what the system actually is, but so are, as astounding as it may seem, officials, central bankers, bank regulators, they're unprepared for the real world too.
Let us continue with the article. Quote, sometimes lenders repledge the collateral to other lenders and take out repo loans of their own. So I skipped ahead a little bit. Now we're discussing the repurchase agreement market, which we often have on this show. And the cycle goes on. It's a little bit like a hot potato, passing the collateral to the next guy, known as rehypothecation. These transfers used to be done once or twice for each posted asset, but are now sometimes done 6 to 8 times, each time creating new money supply. Note, this modern money creation outside the purview of the Federal Reserve, and it's huge. Jeff, that's 6 to 8 times. That sounds like it's a reference to Manmohan Singh, and he's the academic that works for the IMF, and that makes him the rare kind of bird that is interested in money creation, collateral, in the shadows, while also being at a prestigious institution. Is that what we're talking about here? The 6 to 8 times? Is that where that number comes from?
That specific number actually came from, surprise, surprise, the Federal Reserve. Believe it or not, the Federal Reserve has conducted, at least some staff economists at the Federal Reserve have conducted research into rehypothecation and repledging. And what the studies that I forwarded to Andy so he could verify the data, That's what they said. That the collateral, I think, back when the original study was done in 2018, was about 7. I think I've seen them as high as 8 with Manaman Singh, but that specific study was 7. They said more recently might have been the repo multiplier might be down to 6. So I mean, we don't really know, and that's kind of the point here, right? Why don't we know? Why don't we know what's going on in the collateral side of the system? That should be front and center for every bit of monetary policy, and that's really, I think, the subtext behind Kessler's article was like, look, you're doing this QE stuff based on what? Where is this coming from? It's obviously not working, and the more you dig into it, what you find is that you guys don't even know what the hell you're talking about. And if you don't know what you're talking about, why don't we know what we do? Why haven't you fixed that? Why haven't we done anything about this? It's really, why would you wallow around in darkness and ignorance for year after year after year, decade after decade after decade? There's something really wrong with that.
Ideology. Jeff, Manomahan, I can't pronounce that name, Mr. Singh, he was interviewed on Real Vision on December 14th. It was an interview conducted by Caitlin Long, and they talked about repledging. Of course, they got around to it. And Singh reiterated the 6 to 8 times. But get this, Caitlin brought up the fact that in a conversation she had with Raoul Paul, the CEO of Real Vision, and he was talking about his days when he was at the trading desk. He said that 6 to 8, that's just the quarter end number that's posted. Intra-quarter, he mentioned a number of 30 times each U.S. Treasury security, the average U.S. Treasury security repledged, rehypothecated 30 times. Of course, we don't know. As you just said, we don't know, but that was his sense. Can you imagine?
Well, is anybody really shocked by that? I think that I didn't know that number because I'd never heard that interview that you're citing. And so, but you saying 30 times, that doesn't shock me at all. It doesn't surprise me at all because, I mean, look, we know what the banking system does. I mean, Lehman Brothers Repo 105, they jigger around with the numbers, especially intra-quarter. It's part of the process. It's part of what they do. It's all about creating leverage where it's applicable, where you can get away with it. So you would think, again, going back to our point here, you would think that authorities and regulators, at the very least, whose mandate is to regulate banks, would be interested in this. And this, we wouldn't have to have these kinds of, well, what is really going on here? I mean, we had no idea. And even Manaman Singh's estimates, I mean, he's been really good about going into trying to find out where's the source of the collateral. I've referred to him many times before. Is it the securities lending businesses? Is it, where's this collateral? Is it hedge funds repledging? Not just the multiplier, but also the source of collateral. And what you notice is that his estimates are all usually round numbers. And you think round numbers are guesses. They're not real estimates. And this is not, I'm not denigrating his work. What I'm saying is that he doesn't have the tool. I mean, this is a guy from, a high profile guy at the right places who doesn't have the tools to look inside the collateral system. And this is 2021. Why don't we know more about the collateral side of repo? That's really the thing here. And I think that I love the fact that Andy Kessler was pulling no punches to say, look, we need to look at this stuff. It's very important. And I think, as we have discussed before, and I think it was maybe our last podcast or a couple before that one, talk about in Europe, how they're looking at securities financing transactions, these SFTs, which are repo plus other things, including derivatives. And even in Europe, where they're actually investigating these things, it's being conducted at a very, at a snail's pace. They started talking about, hey, we need to look at collateralization and securities financing transactions in 2011, 12, and 13. And here it is in 2020, now 2021. They're only just starting to pilot some programs. And, why? Why is nobody really taking this seriously? And that's really the question I think people need to ask themselves.
In the interview, the Real Vision interview that I cited, that came across the difficulty of getting this information, even for a respectable, well-known academic at the International Monetary Fund.
Who has all sorts of, confidential data sources that we could only dream of. I mean, he has the ability to say, hey, look, knock on your door. We need to find some information. I mean, he could go to a bank regulator and say, this is important, and probably get the bank regulator to say, we need this information. And so, yeah, I mean, why don't we have more information? Why is this stuff still in the shadows? That's really, and to answer that question, if anybody doesn't have an answer readily available, because once you realize this stuff is in the shadows, the entire central bank model as it exists today is completely obsolete. They're out of business. It's that simple.
Let's continue with Mr. Kessler. Quote, that was the scramble for good collateral. But wait, U.S. government debt was $24 trillion in March. Why weren't there enough treasuries around to buy? Because, you guessed it, the Fed has been gobbling them up, $80 billion a month for quantitative easing. Mr. Snider explains, that's you, Jeff, quote, low interest rates were not from the Fed's buying bonds. Let me read that again. You said, quote, low interest rates were not from the Fed's buying bonds, but from stripping the market of good collateral. English, very difficult for me, Jeff. Help the audience understand what I was trying to read.
Yeah, just what we've been saying, especially about T-bills in 2019, early 2020, when the Fed buys bonds, because look, what is that central bank model which is obsolete? The central bank model is, in the quantitative easing era, bank reserves. It's a quantity of bank reserves. And so what they think is monetary policy is driven by raising the level of bank reserves. But in order to raise the level of bank reserves, you have to buy an asset from the banking system. Now, most people equate this to money printing because bank reserves sound like money. They're talked about like they're money and all this other stuff. So it really is, okay, so we have to raise the level of bank reserves, but what are bank reserves? Nobody ever stops and asks themselves what that's question. It's assumed it's money when it's really not. And in the context of you have to buy an asset to raise the level of bank reserves, you're actually removing that asset from the banking system and putting it on the books putting on the books of the central bank outside of the market's ability to, as Mr. Kessler is pointing out, reuse, repledge, and rehypothecate. So quantitative easing, in effect, reduces the ability of banking system to repledge and rehypothecate, which actually slows down the multiplication effect, right? Because if there's fewer treasuries, especially the best treasuries, which are treasury bills, if the Fed is locking those away from the market, you would expect that the entire liquidity system and repo on the collateral side to be constrained by quantitative easing, not eased by it as it's supposed to do according to its name. So quantitative easing is, in fact, potentially, and I think it's pretty well established these days. I mean, it was a contentious debate for a long time, but I think nowadays even authorities will tell you that, yeah, we do. We take collateral out of the system and that presents its own problems. And what they'll say in their defense is that, well, we've opened that collateral we've taken out of our balance sheet back up through in the United States and the Federal Reserve, the reverse repo, which is essentially renting collateral back in the system. And then in Europe, I think it's called the EA or the EAP, whatever. There's an acronym for it. Essentially the same thing, where banks can show up at the central bank level and say, I want to rent collateral from you. But that's not the same thing as, the collateral system itself, the dynamic marketplace supplying and redistributing and repledging collateral organically. And so even if the Fed does say, well, we can, some of the collateral we take in, we'll let it back into the marketplace through the reverse repo program. Yeah, that is true. But it was, we've seen time and again, it's not a perfect substitute for, when we see these safe asset shortages materialize.
Jeff, we've been talking about the United States specifically here when we're talking about bills being stripped, but it occurred to me, as you mentioned Europe, have you heard about anything similar happening in Britain, in Europe, in Japan, where those central banks strip the financial system of the shortest term paper or on-the-run securities? Have you heard anything along those lines from those jurisdictions?
Heard as in, seeing it in the bill prices or the short-term debt price? Yeah, the prices of European sovereign debt, especially the highest quality stuff, German, France, and Netherlands in particular, where are they? Their prices of those debts are even higher. One reason why is because, quantitative easing in Europe has been even more extreme in some cases and has stripped a lot of the collateral out of the system. In fact, again, what we're looking at in a negative yield situation is because of the repo demand, because of the repo market mechanics, it's a liquidity premium. Banks are saying we have huge utilities for these instruments such that we're willing to pay a ridiculous price that the yield on the instrument from an investment perspective is negative. That's a liquidity indication that says these things are valuable for other reasons beyond investments. So back to your point, Emil, that's in Europe, that's all we see. We see that government bonds and safe assets are such a massive premium, you can't even consider them investments. There's something else entirely.
There hasn't been a central bank that you've heard of that has said, well, we're going to stop buying bills. We're just going to focus on the longest term maturities, or we're only going to focus on buying off-the-run securities. No one has said that. Everyone's just buying securities willy-nilly without any consideration to the collateral system.
Yeah, because the main element of the central bank model remains in effect, that they believe that everything runs through bank reserves. Now, they understand there's complications, but I think at the current point, they don't believe those complications are all that much of a problem. As you know, we talked about before in Europe, I forget who it was, the particular ECB official gave you that speech in November where she said, yeah, quantitative easing takes collateral out of the system, but by God, we allow it back in through our securities lending programs, as well as, we've seen the securities lending businesses and private banks tick up too, as if that was a good thing. So, yeah, they see that, the collateral it's something else. It's maybe a nuisance to them because for them, everything runs through bank reserves. We raise the level of bank reserves. That's what monetary policy is. And we'll kind of, we'll investigate any fallout that shows up along the way. When it's, that's exactly backwards. They should have the repo market and collateral on the front burner agenda. And that bank reserve stuff really doesn't rate much at all.
Two more questions. Let's go back to the Kessler article. I'm going to read two more quotes. Then the last one we'll just, summarize and wrap it up. So the first one, here it is, reading along. To fund the CARES Act, the Treasury Department had issued close to $2 trillion in debt. Quote, this is you speaking now, Jeff. When the government auctioned off more T-bills, Mr. Snider tells me, with amazement in his voice, by accident, they provided exactly what the market absolutely needed. Mr. Kessler draws the reader's attention to your tone. Why were you amazed?
Because, first of all, that was the big problem. And second of all, the U.S. Treasury Department had no idea it was the big problem. It was, again, what we keep talking about is this darkness, the shadow over we shouldn't have to be guessing about all of this stuff. And, for nothing, authorities shouldn't have to be doing things by accident. They shouldn't back their way into a solution, not on purpose, unintentionally. And that's really what happened. A lot of the safe asset shortage, the collateral shortage in especially March and April, that's why the credit market sell-off extended into April, because it wasn't until April when the Treasury bill auction process started really ramping up. And so the Treasury Department just said, look, we got to fund the CARES Act. We don't care about repo because it's not really on our radar. It's not a part of our mandate. We just got to fund the deficit, and the deficit's exploding. And the way we do that traditionally is through the issuance of bills. That's the way it's always been done. And so it was standard debt management practice that actually met what was this repo shortage, this repo collateral shortage in T-bills that the Fed had created. So the Treasury Department was partially fixing one problem that the Fed had made even worse. And it's amazing that when you put this together, it's like the Keystone Cops, right? They run around and create such a mess, but at the end of the day, they end up catching the crooks. Not by, good police work or intentional program and design or well-executed plans. It's a huge mess. And again, going back to Andy's particular point here is why? Why is this such a mess? Why do we have to hope that the governments get this right by accident? And it's a confounding thing. It's really, when you stop and think about it, it's a really shocking part of all of this.
I'm going to read I'm going to read Kessler's conclusion right now. And then, Jeff, I'm going to ask you for any final thoughts about the article. Anonymous sources tell me that Jeff's host is very handsome. Okay, quote, to resolve the instability problem, the Fed needs to end QE. Stop gobbling up treasuries. The good collateral, the global economy needs to function. To resolve the instability problem, the Fed needs to end QE. Did I repeat that? Yes. Oh, here we go. The Fed is depriving the rest of the system the oxygen it needs to grow. Global credit is, Mr. Snider tells me, a fragile system that doesn't need much of a trigger to go backward. Here's the last sentence. The least the Fed can do is get out of the way. End QE now. Very powerful.
Yeah, and I think that's, it wraps all of the stuff into one thing. Number one, the myths about QE being effective and money printing and all that. I think he quite, in not a lot of space, eloquently puts it together to say, look, we think this is money printing, but in practice, even in theory, it isn't. In fact, it's probably more harmful than it is positive. So it's not even easing. Set aside the fact that it's not quantitative, right? If you got to do it 4 times, you haven't done it quantitatively. And so what we're saying, and what we're starting to move toward the situation where more and more people are asking the right questions and coming to the right conclusions, which is, what does the central bank actually do? What do these guys really do? And it gets back to what we just said. Why is nobody really taking a serious look at the repo market? And it really is nothing more than, well, if we take a serious look at the repo market as a central bank, we're putting ourselves out of business.
Jeff, very important. We always talk about the bond market. And that's where we're going to turn to next in part 2 of episode 42. The bond market is perhaps signaling that maybe it disagrees with you, or is that not the case? We're going to talk about it more